The fractional banking system is a crucial aspect of modern economies, enabling the flow of credit and facilitating economic growth. At its core, it operates on the principle of banks being able to issue more credit than the amount of reserves they hold. This may seem counterintuitive, but it is through this mechanism that banks are able to meet the demands of a growing economy, while also making profits for themselves. The fractional banking system works by allowing banks to hold a fraction of the deposits they receive as reserves, while using the remaining funds to issue loans to other individuals or businesses. For example, if a bank receives a deposit of $100, it may choose to hold only $10 as reserves, while lending out the remaining $90. This loan can then be deposited into another bank, leading to a chain reaction of credit creation and economic expansion. When a bank issues a loan, it creates new money in the form of credit, which is then added to the overall money supply. This loan can then be deposited into another bank, which can repeat the process of credit creation and lending. This chain reaction of credit creation can have a multiplier effect, as a small increase in reserves can lead to a much larger increase in the money supply and credit availability. The process of credit creation has a multiplier effect, where a small increase in reserves leads to a much larger increase in the money supply. This enables banks to play a significant role in supporting economic growth, by providing the necessary credit for individuals and businesses to invest and expand. In fact, the fractional banking system has been instrumental in enabling the growth of modern economies, providing the necessary fuel for economic expansion. However, this system is not without its risks. One of the main drawbacks of fractional banking is the potential for bank runs, where a large number of depositors may try to withdraw their funds simultaneously. This can lead to a lack of confidence in the bank and its ability to repay its depositors, causing a rapid decline in its reserves. In severe cases, this can lead to the bank's failure and the loss of depositors' funds. The process of credit creation, as mentioned earlier, has a multiplier effect, where a small increase in reserves leads to a much larger increase in the money supply. This occurs because banks are able to lend out a multiple of the reserves they hold, thereby increasing the overall supply of money in the economy. The multiplier effect is a result of the fractional reserve system, where banks only hold a fraction of the deposits they receive as reserves, and use the rest to issue loans. When a loan is issued, it becomes a new deposit, which can then be used to issue another loan, and so on. This creates a chain reaction, where each new loan increases the overall money supply, leading to a much larger increase in the money supply compared to the initial increase in reserves. The multiplier effect of the fractional reserve system can be seen in the recent pandemic, where the increase in reserves led to a significant increase in the money supply. The Federal Reserve, in response to the economic downturn caused by the pandemic, increased reserves by purchasing government securities and other assets, thereby increasing the money supply. This led to a significant increase in M2, a measure of the money supply that includes cash, checking deposits, and other near-money assets. The increase in M2 can be attributed to the multiplier effect of the fractional reserve system, as the increase in reserves led to an increase in the overall money supply. This, in turn, helped to boost economic activity, as individuals and businesses had access to more credit to invest and expand. The increase in money supply during the COVID-19 pandemic has brought with it a number of risks that need to be carefully considered. One of the main risks is inflation, which can occur when the supply of money grows faster than the underlying economy. This can lead to a decrease in the purchasing power of money, making goods and services more expensive. Another risk is the potential for asset bubbles, where prices of assets, such as stocks, real estate, and commodities, rise rapidly due to increased demand and a surplus of money. This can lead to financial instability and potentially a bust, as prices eventually come back down to more reasonable levels. Additionally, the increase in money supply can also lead to an increase in debt levels, as individuals and businesses are able to access more credit. This can have negative long-term consequences for the economy, as excessive debt can make it more difficult for individuals and businesses to make ends meet and can lead to an increase in bankruptcies and defaults. Furthermore, the increase in money supply can also have a negative impact on the value of a currency, as the increase in supply can lead to a decrease in demand, causing the currency to depreciate. This can make imports more expensive and exports less competitive, affecting the overall trade balance of a country. Another risk of the increased money supply is that it can lead to imbalances in the financial system, as money flows towards speculative investments rather than productive investments. This can lead to misallocations of resources and can negatively impact economic growth and stability. The increase in money supply can also lead to greater income inequality, as those who have access to credit and capital benefit the most from the increased money supply, while those who do not have access to these resources are left behind. This can lead to social and political tensions and can undermine the stability and growth of an economy. To mitigate these risks, governments and central banks have put in place a number of measures to ensure the stability and security of the fractional banking system. One such measure is the requirement for banks to hold a minimum amount of reserves, known as the reserve requirement. This helps to ensure that banks have enough funds on hand to meet the demands of their depositors, even during periods of economic stress. Another measure is the provision of deposit insurance, which provides depositors with protection against the loss of their funds in the event of a bank failure. This helps to ensure that depositors do not lose their savings, even in the event of a bank's collapse, thereby maintaining confidence in the banking system. In addition, central banks play a critical role in maintaining stability in the fractional banking system, through their ability to control the money supply and interest rates. By adjusting these parameters, central banks can influence the demand for credit and the flow of funds in the economy, helping to maintain stability and avoid periods of economic turmoil. The increase in money supply during the COVID-19 pandemic has the potential to cause high inflation because of the excess supply of money in the economy. When the supply of money grows faster than the underlying economy, it can lead to a decrease in the purchasing power of money, making goods and services more expensive. This is one of the key characteristics of inflation and can have negative impacts on the economy. Moreover, the increase in money supply can also lead to imbalances in the financial system, as money flows towards speculative investments rather than productive investments. This can lead to misallocations of resources and can negatively impact economic growth and stability. Additionally, the increase in money supply can also lead to greater income inequality, as those who have access to credit and capital benefit the most from the increased money supply, while those who do not have access to these resources are left behind. The potential for high inflation highlights the importance of careful and well-managed monetary policy. Central banks and governments need to ensure that the increase in money supply is accompanied by a corresponding increase in economic activity and productivity, and that inflationary pressures are kept in check. While the increase in money supply during the COVID-19 pandemic was necessary to support economic growth and stability, it also brought with it the risk of high inflation. This highlights the need for careful and well-managed monetary policy, as inflation can have negative impacts on the economy and can undermine the stability and growth of an economy. In conclusion, the fractional banking system is a complex and dynamic system that plays a critical role in supporting economic growth and stability. While it is not without its risks, these are effectively managed through a combination of regulatory measures and the actions of central banks. Through its ability to facilitate the flow of credit, the fractional banking system enables individuals and businesses to invest and expand, helping to drive economic growth and prosperity. This is for educational purposes only and should not be taken as financial advice. The information provided is not intended to be a substitute for professional financial advice. Please consult a financial professional before making any financial decisions. Please comment, like and subscribe.